Okay? So, here's what we did. What we did is, here's the accounting cycle that includes the additional things. So again, just as before, you start out with a business transaction, right? And that's anything that changes the accounting equation. Then that produces a source document, which is written proof that it existed. You journalize that, and the journal is the book of original entry, and it pairs the debit with the corresponding credit, and pairs that with an explanation. And the explanation is supposed to refer back to the source document, preferably some identifying number or name or date or whatever, okay? Then you post from the journal to the ledger, and the ledger starts to summarize. It's every account you have. The chart of accounts is like the index to the ledger. Each of the ledgers have their own account number. Then at the end of the accounting period, you take the ending balance of the ledger and you produce a trial balance. And the trial balance, it is a financial statement, but it's different from other financial statements because what it does is it verifies the accuracy of your accounting. And it's surprisingly powerful. And just like I mentioned, that's why we do the double entry bookkeeping, because we can check our accuracy as we go along, right? And that's why it justifies writing the same number twice. Okay? All right. And by the way, you guys, Sharon, if you guys give me, is it Nick? Eric, all right, I just didn't know your name. I didn't mean to pick on Sharon, but I didn't know your name. All right, give me your attention. I'll put everything back in the board when you're done here. All right, so then what you do is you do the adjustments. And then you journalize the adjustments and post them to the ledger. And then you do another trial balance to check the accuracy of all this. And that's called the adjusted trial balance. Now, if that's the adjusted trial balance, the one you did before is the unadjusted trial balance, right? And the only difference between the two is when you do them. This is before the adjustments, this is after the adjustments. Then these, because the accounts here are current, those are the ones you use for your financial statements. Okay? Now, a couple things here. What we did on this is I'm just kind of putting this stuff together, is when you do the adjustments, what you do is you do them on a worksheet, and a worksheet looks like this. And because it's reviewing, I won't turn the camera on. So what you do now is on the worksheet, you have all the accounts that you do over here on the left, all the accounts you have on the left, and you put their balance, and you find, and you verify that the debits equal the credits, okay? And you do that on the worksheet. And then, of course, down here, so this is the worksheet, down here when they equal, then that is the trial balance, and this is where you do it. And it's like it's an Excel spreadsheet. Now the next column you notice are the adjustments. So this is where you calculate the adjustments. So let me put up the one that covers that. And here's what it looks like. So this is all the adjustments. In fact, I'll put it on the other board so we can just kind of watch the continuity come out here. So here's the adjustments. Okay. So now, so for instance, let's just take one of these. So here we have accounts receivable. It's debited for $1,800, and down here is a credit of $1,800 under consulting revenue. So what they did here is this is one of those accrued revenues. So what they did is they're going to be paid when it's finished, right? And so this is the amount they earned in this accounting period. You want to put that revenue in this accounting period, okay? So, but this is where the adjustments are. Now you're going to combine the adjustments with the unadjusted trial balance to get the adjusted trial balance, and it will look like this, okay? So let's just choose one to see how it goes through. Let's choose supplies because it'll illustrate better. So on supplies, here was the ending balance in your ledger. Here's the amount that was used up. That's the adjustment. Then this is the amount that's left. That's the unadjusted balance, and it's the current amount. And this is where you then use these current amounts to do your financial statements. And this is where it's done. Okay? All right. Then we also went over the ratio for this chapter. And the ratio is the profit margin. So let's kind of walk through that. And so with the profit margin, let me kind of put this up here. So with the profit margin, basically what it is it's the profit margin is the ratio. It's net income over net sales. Both of these come off the income statement, right? Now net sales, what net sales is it's the updated sales account. So we've been using the income statement, we have revenue minus expenses equals net income. Sales is a revenue account, right? Okay, so revenue is kind of like a category, sales is a specific account. Net sales are real sales because in this case you have sales minus sales returns and allowances. So what this means is it's gross sales minus what your customers bring back. That gives you net sales. And of course if your customers bring it back, is that a sale? Hardly, right? So here's what net sales refers to. So the net sales is after adjusting for things like the stuff your customers brings back. So the net sales is the same as net income. I'm sorry, net income comes off the bottom of the income statement. Net sales comes off the top of the income statement. In this case, your net income is $40,000. Your net sales is $100,000. That's 40%. What that tells you is every time you sell $1 worth of goods to a customer, 40 cents goes in your pocket. It also allows you to keep on top of things. So for instance, it's so easy to let expenses get out of control. They keep creeping up, and everybody's used to it. But you also need to correspondingly increase your what you charge for things if you have greater expenses. So by doing this, you can make sure that expenses aren't eating up your profit. You can keep on top of things. Okay? And then I think the other thing that we went through is the fact that don't forget what you want to do is you want to apportion, what you want to do is you want to put the expenses in the period when they occur. So if you have something like an insurance policy that was bought before the current fiscal year started and it will expire after the current year started, all you want to do is you want to get the 12 months in this fiscal year as the expense for this fiscal year. Okay? All right, you guys doing good? Well, that does it. I'll put the stuff back on the board, and